Hey, welcome everyone. It is 10:30, and we are going to get started here. We got about 500 people on the call. We sold out. Wow, Social Security. My name is Joe Anderson, certified financial planner, president of here at Pure Financial Advisors. And we have a mission. We want to educate you. We want to make sure that we get really good information out to you. And so I have a couple of promises. I want to get you really good information. I try to be a little bit of, I guess, some entertainment in here, but with Social Security, I can't promise you anything on the latter. So let's dive in. I want to get into kind of the backdrop a little bit here on Social Security. Right now, we got 65 million receiving Social Security benefits today. And if you look at the landscape, I'm sure you all know of the baby boomers. There's 10,000 baby boomers turning 65 every single day for the next 13 to 14 years. So that's going to put a little bit of strain on Social Security and when it comes to your claiming strategies. I'm going to break things down for you in regards to the history of Social Security. We'll look at when should you claim, what is a popular claiming strategy. We'll look at spousal benefits. We'll look at survivor benefits. And we'll take a look at the taxation of Social Security and all other good stuff. I want to get out of here within an hour. So there's a ton of information I want to go through. If you know me, I'll go quickly in some areas, but I'll slow way down where I want you to grasp. And there's a little button on your webinar. So if you have a question at all, please feel free to throw some questions out there. I'll make sure that I answer all of the questions. I can't promise you I'll get them all answered during this webinar, but my goal is to get you the right information. With Social Security, it's crazy because, you know, you got, if you're married, there's several hundred different claiming strategies. I mean, we would be here for weeks if I took every single question like that. So if you do want to send those questions, or you can email me directly, which a lot of you already have, at joe.anderson@purefinancial.com. You know, Social Security was signed in 1935, FDR, and the reason for that is that, you know, the Great Depression. And we didn't want any American to endure what they did back then, so there would be some form of retirement income available. Social Security was never meant to be the end-all, be-all, to provide you 100% of your income in retirement. It was there to keep you out of poverty, basically. 1975, we actually had the first cost of living increases in our Social Security benefit. And then 2016, we had some last year. We had some advanced claiming strategies that were eliminated. But it's not all for loss. There's still things that you can potentially do. It really depends on your age, and I'm going to dive into those. Because the Bipartisan Act that was signed in 2015 and came into effect in 2016, I think a lot of individuals thought that those claiming strategies were over. And the answer is no. There's still some things that you can do. It gets a little complex, but I'll do my best to explain it to you. You know, it's funny, Social Security, when it was signed in 1935, the first person to ever collect a monthly benefit, her name was Ida Mae Fuller, and she lived to actually age 100. So as you can see, it puts a little strain on the overall benefit. Because here's what they thought. Right? Back in the 1930s, life expectancy was age 58 for men, 62 for females. And back then, your full retirement age was age 65. So if the average life expectancy, people died before they even reached their full retirement age, quote unquote, is that, hey, you know what, the system will be able to last quite some time, which it has. But if I look at life expectancy today, you know, a female's life expectancy is almost 90 years. A male's almost 86. So with that being said, we're living a lot longer. And so when it comes to your Social Security claiming strategy, you want to make sure that you do this right. Calculating your benefit is where I want to dive into. Here's where I suggest everyone go first. Go to ssa.gov, estimator. This is an online benefit calculator. It's right there at the Social Security Administration. It's a really good resource. If you have not signed up for your own account, I would encourage you to go right now, ssa.gov, and then it looks at your earnings. It will take a look at a guesstimate of what your benefit you will receive at age 62, full retirement age, and at age 70. So if you haven't gone to SSA.gov estimator, I would encourage you to do that at some point. Now, how do they calculate your benefits? This is where I receive a lot of questions. It's 40 quarters of work or 40 credits, and I'll explain what that means. And then they basically look at the 35-year highest years of working. So it's the highest 35 years. So if you have not worked for 35 years, right, if you took some time off or you do not have those credits within that time period, then they just plug zeros in. And so what they do is they look at the top 35 years of wages, and then they use a wage increase given inflation, and then that comes up with your primary insurance amount. And that is the key number that you want to make sure that you understand. If you're married, there's multiple different strategies. So I receive a lot of questions, but without your primary insurance amount, it's very difficult to identify what is going to be the appropriate claiming strategy for you. So your primary insurance amount is usually located right on your benefit statement. If you do not receive the benefit statement in the mail, that doesn't mean you're not receiving benefits anymore. That means they stopped doing that, and they mail them out, I believe, every 5 years. Go back here to SSA.gov, and you can receive that right there online. So then that's going to determine what is your primary insurance amount, what is your monthly benefit. And so they look here, it's one credit for every $1,300 earned in a maximum of 4 credits per year. Now this increased a little bit in 2017. So $1,300, so that equals 1 credit. Before they called them quarters, and it was a little unfair. They changed the law. I'm not sure how many years ago, but let's say if you worked maybe seasonal work and you didn't work throughout that 12-month period, so now it's just a credit. So if you make $1,300, you receive 1 credit, all right? So multiply that by 4, about $5,000. Then you got your 4 credits for that year. You can earn that within a day, a week, a month. It all really depends on what your income is. Here's some interesting fun facts. If I take a look at the average Social Security benefit, it's about $1,360 for a retired worker. If you are married and both people are receiving those benefits, it's about $2,200 a month, $2,300 a month, which is fairly significant for a lot of individuals. So that's why getting this thing right really makes sense, to spend a little bit of time to understand how the mechanics work. Now, if you've maxed out your overall benefit, the highest benefit is for 2017 is about $2,700 a month, $2,687. Now that's at your full retirement age. Now this year, your full retirement age would be 66 years and 2 months. It all depends on when your birthday is. Now, if you decide to delay your full retirement benefits, you get an increase in that benefit. It's 8% delayed retirement credit per year that you wait. So it might make sense for some of you to wait. It might make sense for some of you to take it as soon as you can get it. It really depends on your overall situation. But if you've maxed out, and what I mean by maxed out is that the Social Security Administration taxes us, it's about 6.2% on earnings. All right. So the maximum taxable earnings is $127,200. So they take 6.2% withholding for Social Security or FICA tax. The total actually is 12.4. So for those of you that are self-employed, you pay both the employee and the employer side. So $127,200, that is the maximum that they'll take from you as a tax. Now, if you've maxed out that tax each year, this is the maximum benefit that you would receive at your full retirement age. Now, a couple of other increases in 2017, a few other quick changes here. We got a little bit of a bump. Last year, there was no cost of living increase. This year, it was 0.3%. So it's not a ton. I guess it's better than 0. But if you look at the average benefit that someone received, you know, the benefit increase was like $4 a month. So I guess that can get you some coffee, but at least it's in the positive. When do you take your benefit? Now this is what everyone's really looking at to figure out. How do I do it? Well, let's just kind of start with the basics here. At age 62, that is the first time that you can receive retirement benefits. Now you can receive benefits as early as 50 if you're disabled. 60 if it's a survivor benefit, and I'll get into that in a second. Your full retirement age, this year it's 66 and 2 months, and age 70 is going to be the largest benefit that you would receive from the Social Security Administration. So you can take it as early as 62, you can take it at your full retirement age, you can take it at age 70, or any other month from 62 to 70 that you desire. So if you do take it at 62, all right, just understand this, is that let's say if your full retirement age is 66, just to make the math easy on me, your benefit is going to be reduced by 25%. Now, that is a permanent reduction if you collect it at 62. So if you retire at age 62 and you want your benefit, just understand that you are going to receive 25% of your full retirement age benefit. The reason why they reduce that benefit is because you're collecting at 62 versus, let's say, 66. So you're receiving it a few years early, so they're going to reduce that benefit. Now, if you wait till full retirement age, so you would receive 100% of your retirement benefit. Age 66, if you were born between 1943 and 54. Now, if you were born after that, you're going to get a 2-month delay for each birth year between 1955 and 60. If you were born after 1960, your full retirement age is age 67. Now, at age 67, if you decide to take it at 62, then your benefit is reduced by 30%. So if you take it at 66, your benefit is reduced by 25%. Now, if your full retirement age is 67, they're going to reduce it by 30. Now, this is where it gets a little bit interesting, and this is where I think a lot of questions come into play. So we have a benefit increase of 8% per year if you're born between 1942, all right? That's a permanent increase. It's called a delayed retirement credit. It maxes out at age 70, so it makes no sense not to take it at age 70 or before. So here's the question that I always get, Joe, when should I take my Social Security benefit? Should I take it at 62? Should I take it at full retirement age? Or should I take it at age 70? Well, it all depends on several different factors. Let's just kind of take a look at the numbers for a second. If you take your benefit, let's say at full retirement age at 66, and let's just assume your benefit is $1,000 per month. If you take it at 62, just know that you're going to receive that 25% permanent haircut. In this example, it'd be $750. If you waited until age 70, now your benefit is $1,320. So that's about a 73% increase from age 62 to 70. It's significant. So when do you take it? Well, I don't know. It's a bet to live strategy, right? So if you have short life expectancy, you take it right away, of course. If you need the money, if you're retired at age 62, you're not working, you need that cash flow, take the money. If you're if you don't have a lot of other assets, you take the money. However, if you do have assets, and now then it gets a little bit more complex, because it's like, well, should I draw down from my assets and let this continue to grow? Well, an 8% delayed retirement credit, in my opinion, is fairly significant. If you take a look, I don't know, at the 10-year Treasury today, it's what, 2.5%? That's the risk-free rate. So if you want a riskless asset, and if they're going to give you this 8% delayed retirement credit, you know, hey, that's significant. If you think that you can take it at 62, invest the money, right? And then now you have a larger lump sum, that might be an option for some of you too, but you have to run the numbers. You have to do the math. A lot of you want to look at this break even. So if I take it at age 62, right, and then because I'm collecting it 4 years early than my full retirement age, right, or potentially 8 years before 70, well, that's money in my pocket that I can either spend or save. True. So let's say if you save it, well, then it depends on what type of assumptions that you want to use in regards to an expected rate of return on that money. So if you don't need it and you want to take it at 62 and invest it, all right, well, yeah, that's your prerogative. I got a question here. It was like, Joe, I'm about to turn 62. I cannot decide upon when to start collecting my Social Security benefit. Every financial advisor I've listened to has advocated waiting as long as possible before you should start collecting. This individual's crunched the numbers, and although I can see high financial benefit if I wait, if I live till I'm 90, but if a life expectancy, let's say, is age 84, I just don't see the big, incentive to wait. And you're absolutely correct. We don't know what the future is going to hold, right? So if you think you're going to pass away in your early 80s, it probably does make sense to take it as soon as you can get it. Here's the stats. Most people are still doing that, right? So I know this could be a little bit difficult to read, but on the left-hand side, women age 62, about what we call it 50 some odd percent are taking it at 62. About 20% are taking it from 63 to full retirement age, and a very small percentage of women are taking it past full retirement age. Flip side to the men, the numbers are fairly similar. Most people are still, the majority of people are still taking it at age 62. And then a small portion is taking it from 63 to full retirement age. And then you can see the numbers, and then still even fewer people are waiting till age 70. Just because you can collect your benefit, that doesn't necessarily mean you should collect your benefit. Each person's a little bit different. Because let's say if you do decide to take it at 62, you're going to say, you know what, I want the money. I'm going to take it as soon as I can get it. Well, if you're still working, all right, if you are collecting wages or self-employment income, just understand this. If you make more than $17,000 or $16,920, all right, from 62 to your full retirement age, every $2 that you earned on top of that, they're going to take $1 back. Now, once you reach your full retirement age year, all right, you can make up to $44,880. What that means is my birthday's in June. Right, so let's say if I take my full retirement age will not be till June. So January through June, I can make roughly $44,880. If I make more than that, every $3 earned, they're going to take $1 back. But once I reach my full retirement age, there is no benefit reduction. There is no limit. I can make as much as I want. All right, they're not going to reduce my benefit or take it back. There's no reduction here. Let me give you a quick example. Let's say you're 62. Your Social Security benefits $1,250 a month or $15,000 a year. And if you're still working, now this is wages. This is self-employment income, wages and self-employment income. This is not interest, dividends, 401k distributions, pensions, anything like that. This is you actually working, collecting a W-2 paycheck or working for yourself as a self-employed individual and getting either 1099 income or Schedule C income, whatever. Now, $40,000. So this $16,920, again, that's there. That's the limit. That's the earning limits for 2017, $16,920. So you take your earnings, $40,000 minus $16,920 equals $23,080. Now remember, for every $2 earned, they're going to take $1 back. So you divide that by 2. So then the factor is 11,540. You take 11,540, you subtract it by $15,000. What's that? Roughly $3,000. All right. So your benefit is not going to be 15 grand. It's going to be about $3,000 because they're going to reduce that benefit by 11,540 bucks. Now, this is where you have to take a look at a few different things. If you plan on working, so you collect your benefit at age 62 and you already know that you're going to work, you have to calculate this benefit and make sure that you notify the Social Security Administration. Because here's what happens. They know that you've made earnings, right? They collect all of our earnings since we've started, birth basically, since we started working, they know what we've earned. So let's say if I did this and I collected my benefit of $15,000 per year, right? So I'm receiving that paycheck. I'm also, let's say, working and making $40,000 a year. Well, now I'm double dipping in the eyes of the Social Security Administration. So they'll do this calculation at the end of the year when you file your tax return. So in this scenario, so you owe them back 11,540 bucks. So you would then, at this case, not necessarily receive a Social Security paycheck until you pay back that 11,540. Now, the benefit is not lost, all right? Basically, it's just deferred. Now, this is where it gets a little bit confusing. So let me go back to these numbers here. So 11,540, all right? So if I divide that by, that's about 10 months of earnings. All right, so 10 months of earnings out of 12 months out of the year. So they're just going to assume I did not collect that benefit for 10 months. So my increase, because I took it at 62, remember, you're going to receive that 25% haircut. They're going to say, you know what, no, you took it not at age 62, you took it at age 62 and 10 months. So my haircut is not going to be 25%. It's going to be something less. And let's say I did this again next year. So now that's 20 months. That's almost 2 years. So they're going to say to me, Joe, you didn't collect the benefit at 62. You basically collected it almost at age 64, 63 in 8-9 months. All right. So it gets a little bit confusing there, but I guess the moral of that story is that if you're going to take your benefits at age 62, all right, be careful because there's these earning caps. So if you make more, again, let me go back to these numbers for you. It's $16,920. All right, just know every $2 earned, they're going to take $1 back. Once you reach your full retirement age, it's $44,880. If you do plan on working, just make under that $16,920 limit. They're not going to reduce your benefit. So then you can claim your benefit early at 62, make $16,920 of wages or self-employment, and you should be fine. Any dollar over that, just do your calculation. I helped you with the math here, and just make sure that you understand. Don't be surprised that, let's say if you did claim your benefit, then all of a sudden the following year you worked, and it's like, well, what happened to my benefit? What are they doing here? Well, no, they reduced it because there's an earnings cap. All right. Now, let's get into spousal benefits. Spousal benefits can be somewhat confusing. Now, this is, of course, if you're married or were married to someone for 10 years. All right. So what is a spousal benefit? How much do you receive for spousal benefits? Well, it's 50% of the spouse's full retirement benefit if you take it at full retirement age. You can collect a spousal benefit as early as 62, but just understand you're not going to receive 50% of your spouse's benefit. It's going to be something smaller than that because, again, you took it early. So benefits reduce if you collect before your full retirement age. There's also these earning caps, too, on spousal benefits. So spousal benefit or your own retirement benefit, there are the income or the earnings caps that you have to be aware of. So are you eligible, first of all, for spousal benefits? Well, if you're 62, so that's the earliest that you can claim a retirement benefit. And for this webinar, we'll just assume that the spousal benefit is a retirement benefit. Okay, so if you're 62 years of older, okay, or if your spouse is eligible for Social Security benefits, or ex-spouse. Now, there's two different rules when it comes to ex-spouses and spouses. If you want to claim a spousal benefit, all right, again, a spousal benefit is 50% of your spouse's benefit, all right? Your spouse has to be claiming their own benefit for you to claim the spousal. If you want to collect on an ex-spouse's benefit, they do not have to be claiming their benefit, okay? So if you want to claim on an ex-spouse, you have to be married to that ex-spouse or had to be married to that ex-spouse for at least 10 years, Now, let's say if you were married to two ex-spouses and both of those marriages last at least 10 years, you can pick the higher of the two. So if you were married twice, okay, and no longer remarried, then you can select the highest of the two when it comes to an ex-spouse's spousal benefit. The spouse must be legally married, so you have to be married for at least 1 year to collect that benefit, or if it's an ex-spouse, again, 10 years. Now, if you take it early, right, you're not going to receive 50% of the spousal benefit. You're going to receive something less, 35 to 49% if you claim it early at 62. But once you reach full retirement age, then your spouse's benefit, right, you can claim half of their benefit. If you are working again and you decide to claim the spousal benefit early, just know that if you make more than $16,920 or $44,880, they're going to reduce that benefit. All right. If you are at full retirement age, there is no benefit reduction. So if you're at full retirement age, you want to claim the spousal benefit because the spousal benefit is larger than your own, then you can still work and claim that benefit. So what's the best claiming strategy here for a married couple? Few things to consider if you're married. And now this is rules of thumb, but I still think it makes a lot of sense, is that the spouse with the larger Social Security retirement benefit should try to push their benefit out as long as they possibly can, because then that turns into a survivor benefit. So let's say you have two spouses. One has a Social Security benefit of $3,000. The other one has a benefit of $1,000. Well, when you look at the spousal benefit, the individual with $1,000 benefit, their benefit would increase to $1,500. All right, so that's the first step of kind of calculating this. You have one spouse with $3,000 a month. I'm just hypothetically, so the math is easy for me. And then let's say the other spouse is $1,000. All right, well then that jumps up to $1,500 a month. So then their total combined household retirement income would be $4,500 in that example. Now, let's say the individual with the $3,000 a month benefit decides not to take it at full retirement age. They want to get that increase. So if they wait until full retirement age, they get that 8% delayed retirement credit or 32% more benefit if they wait until age 70. Now, that is locked in. So if they were to pass away, that much larger benefit then gets transferred to the surviving spouse. So in that example, $3,000, they increase that benefit by 32%. So let's say the surviving spouse is, so that's about $10,000, we'll call it $4,000. So now their benefit is not $3,000, it's $4,000 per month. And then the other benefit is $1,500. So if that spouse with the larger benefit passes away, that $4,000 automatically gets transferred to the surviving spouse. So the best claiming strategy, first step, is to take a look at, all right, well, what is your PIA, your primary insurance amount? And then you look at who has the larger insurance amount or the larger retirement benefit. That individual may want to increase their benefit as much as they can just to protect the surviving spouse. Because the survivor benefit's huge, right? So if you take a look at the survivor benefits, all right, well, what does that mean? Well, again, the survivor is going to receive, all right, what that their spouse, the surviving spouse benefit was. So it depends. They need at least 6 total credits, 3 years prior to death. But here's the biggest thing, that survivor benefits do not get that delayed retirement credit. You have to be alive, right? So if I'm still living and if I want to delay my retirement credit, you might want to do that as long as you can. Because then, let's say if you pass away and then the surviving spouse says, hey, I don't want to take it, let me try to delay that benefit so I get a larger benefit, it's not going to work. You're going to get the highest of full retirement age benefit, right, if they took it early, right? So if the individual that passed away took their benefit early, let's use this as a quick example, all right? Took it early. So let's say they received that 25% permanent haircut. Now the surviving spouse is going to say, you know what? All right, well here, they took that early, so that's going to lock in a permanent reduction in their benefit, the surviving spouse's benefit for their life. So that's why it's always good rule of thumb to look at, all right, well, if you're married, then one spouse that has a larger benefit should increase their benefit to give their surviving spouse a little bit more cushion, because now there's only one benefit. You lose a Social Security benefit. Here's another quick tidbit too, is let's say that if you did decide to take it early, I'm going to take my benefit at age 62, right? And then I pass away and my benefit is larger than my spouse's benefit. She actually gets a little bit of a step up. It's not going to be a 75% reduction. It's about 82.5. I don't know who comes up with these crazy rules, but that's just what it is. So just FYI there. Again, there's a ton here. If you have questions, please go in that box, ask a couple questions. I don't know, do we have any questions? Okay. There's no way I can read that small print, but we'll try to get it going. Or you can always email me and give me your real information, and then I'll give you my best guess of what you should do. All right, well, how long must you be married to qualify for survivor benefits? All right, 9 months. So if you were married for at least 9 months and then, God forbid, right, your spouse passes away, then you qualify for survivor benefits. The survivor benefit is either going to be, all right, well, you take a look at your benefit versus the survivors, and whichever benefit is larger is the one you will take. All right, so you got to be married for at least 9 months. Now, you can take the survivor benefit early. You can take it at age 60. All right. Now, if you're disabled, it's 50, but that's really bad news, and I don't want to go there. So let's just look at more common. 60. All right. So if your spouse passes away, you can claim, all right, a survivor benefit for you, all right, at age 60. If you take it at age 60, you are not going to receive 100% of that spouse's benefit. You're going to receive a reduction, 71.5 to 99. If you wait until your full retirement age, you will receive 100% of that full benefit. So if your spouse dies, okay, now you're going to have a decision to make here because you still have your own benefit. So you could say, well, do I want to take the spousal benefit or do I want to take my own benefit? All right, well, that's a strategy that you can take a look at. Some cases, it might make sense to take the spousal benefit, or I'm sorry, the survivor benefit early. All right, you take that benefit as soon as you can get it, let's say, as long as you're not working again. So if you're working, this blows up on you. You have to wait till full retirement age because it's those earning caps that we went through. So if you're not working at age 60, you can collect the survivor benefit. Just know it's going to be about 71.5% of what the survivor benefit is. You could collect that benefit, and then you can let your own benefit continue to accrue. These are two separate benefits. They are two separate. A survivor benefit and your own retirement benefit are two separate things. So you could take the survivor benefit and let yours continue to accrue. And you say, all right, well, I'm going to wait until age 70 to turn mine on because then I get that 8% delayed retirement credit, and then I can flip the switch and then put my own retirement benefit on. How to make this decision is going to depend on what your benefit is and what the spousal benefit is. Just know that there's strategy there. So you might say, all right, well, I'm not going to take mine. I'm going to take the survivor benefit. I'm going to let mine continue to accrue. You know, my father died at age 62. My mom was 58. And then so she was still working, but then when she retired at 62, she took her survivor benefit. She's going to let her benefit continue to accrue till age 70. And then at age 70, she's not going to take the survivor. She's going to flip her own benefit on. Survivor benefits and spousal benefits, all right, they do not get that 8% delayed retirement credit. They don't. So that's where the strategy comes into play to see what makes more sense. Also, if you're working again, if you want to take it at 62, right, just that $16,920, and then the full retirement age, $44,880. All right, so what do we got? We got a question here? So we'll pull up some questions. Megan's working on some questions. What if you were divorced but married for 10 plus years? Okay, so that's from Chris. Yes, so this is again on the spousal benefit. The spousal benefit, as long as you were married for 10 years and now divorced, all right, you can claim on a spousal benefit. If you were married for 10 years and now divorced, can you claim on a survivor benefit? And the answer is yes. All right, so if that person passes away, no problem. You can still claim on that benefit. So also, if you have children under the age of 18, they would also receive a benefit. Unmarried children under the age of 18, survivor spouse can also, but again, I went through this, they reduce their benefit at age 60. What if you remarry? So let's say this happens, all right? Your spouse passes away and you start collecting your survivor benefit, okay? Well, as long as you remarry after 60 years old, it's not going to affect your benefits. If you marry prior to 60 years old, then it's going to affect your survivor benefits. So let's say you were married, that spouse passes away, you start collecting your your survivor benefits from 60 to 65, right? You start taking that, I don't know, and then maybe age 70, you want to get remarried. That's not going to affect the benefit that you're receiving from your ex-spouse, all right? Remarriage will not affect children receiving benefits as well. So we get this, hey, you know what, my children are receiving a survivor benefit from my deceased spouse. If you get remarried, it will not affect their benefits. It will affect yours if you are under the age of 60. If you can hold off, right, and wait until age 60, it's not going to affect that benefit. So who's eligible? If you're a widow, all right, divorced widow, if not remarried, okay, children, deceased parents, if they claim as a dependent on their tax return at age 62, all right. So widow, divorced widow, children, again, but if you remarried, if remarriage is after 60 years old, it's not going to affect the benefits, okay? Remarriage does not affect your children's receiving benefits. All right, we got a couple more questions here. Are earnings that exceed your retirement benefit based on earned gross income or adjusted gross income? That's a great question. It's basically on, I'm going to really it's MAGI, modified adjusted gross income, on this earnings test. So you want to, there's gross income, there's adjusted gross income, there's modified adjusted gross income, there's taxable income. So the earnings test is based on, I mean, real simply, it's just look at your AGI and that will get you close, all right? So that, so if you want to look at how that's going to affect, just look at your adjusted gross income. Here's another quick question. If your spouse takes benefit early, all right? If your spouse takes benefit early, does that reduce the survivor benefit as well? Yes, let's say if your spouse is collecting their benefit, all right, and they collect it early, right, and if they pass away, it's going to affect the survivor benefit. It's going to be basically what that benefit is. If they claimed it at 62, then they received that 25% permanent haircut, well, you get a little bit of a step up to about 82.5 or 83.5. But yes, it will be reduced. That's why I think it's so important to push these things out. Real quickly, I'm running a little bit, there's child benefits as well. So dependents, you know, how much do you receive for children's benefit? Well, it depends. As if you pass away, there's a survivor benefit for the kids if they're under 18, and also if they're under 19, 20 years old. Let's say if you are collecting a retirement benefit, then your kids also would receive 50% of that benefit if you're collecting a retirement benefit. A lot of us are waiting to get married. We're having children a lot later in life. So you want to take a look at this. If you have kids that are minors, it might make sense, or if they're in school, it might make sense to claim your benefits. It probably doesn't make any sense at all to push this thing out, because then you're missing some of those children benefits. Understanding the family maximums, your family maximum is usually 150 to 180% of the worker's primary insurance amount. All right, so 150 to 180% of the primary insurance amount. If you, what this means, if you have a bunch of kids and you're in your 60s, right, that they're minors, and so you have 8 kids, well, they're not going to be, they're going to max you out at about 180% of what your primary insurance amount is. Real quick on strategies, a couple of things that you don't know. You can always reset your Social Security benefit. You can only cancel once. So let's say if you take your benefit and you realize now, hey, maybe I should push this thing out. You have a redo, but it must be within 12 months of you beginning to receive your benefits. All right. You must repay all of the benefits. So within 12 months, let's say you received $1,000 a month, $12,000, that was your benefit. You have to give the Social Security back the $12,000, then that's a total reset. Then you can wait until age 66, 68, 70, whatever's a better strategy for you. Last thing, taxation on your benefits is so key when you're looking at a retirement income strategy. Now, this is where you have to really start taking a look at, okay, well, how am I getting taxed? Now, this is not adjusted gross income. This is based on provisional income. What provisional income is your adjusted gross income with some add backs. They add back your half of your Social Security benefit. So if you're making less than $25,000 or $32,000, if you're filing a joint return, they're not going to take anything back from you. $25,000 on your benefit as single, $32,000 married. Now, looking at these numbers, this came out under a bill Reagan signed in 1983. Right? And this was only going to affect 1% of the population. They said, hey, we're going to start taxing Social Securities. It was back in 1983. Everyone was up in arms. And then, but wait, let's just take a look at the income limits. It was only going to affect, the 1%, the nasty 1%, right? Well, guess what? They never inflated this with inflation. So now everyone just about that has a little bit of assets are paying taxes on their Social Security. They're means testing now Medicare. They're doing the same thing on the Medicare side. So you have to look at how all of this is going to be taxed and if there's ways to avoid it. If your provisional income is between $25,000 and $34,000, $32,000 and $44,000, all right? So then 50% of your Social Security benefits are going to be subject to tax. Then you get 85% is if your income is over $34,000 or $44,000. Then 85% of your benefit is subject to income tax. The good news is, right, is that 15% of your benefit is tax-free. For those of you that are living in here, beautiful Southern California, where I am at right now in my office, you also will not be taxed from the state of California. The state of California does not recognize Social Security income as taxable income, so that would be tax-free on your state return. So 34 to 44, 85% of it's subject to income tax. So if your benefit is $10,000 a year, $8,500 is going to be subject to income tax. So where's the income coming from? Now, it could be provisional income is going to be interest, it's going to be dividends, it's going to be 401k distributions, it's going to be pension income. If you're still working, it's going to be wages or self-employment income. And then also half of your Social Security benefits. If you're single, your benefit's $20,000 a year. Well, the floor, they start at $10,000. And then how much interest, dividends do you have? Do you have capital gains? Do you have 401k or IRA distributions? Do you even have municipal bond interest? They calculate all of that. Basically, the only income that they do not recognize is going to be tax-free Roth distributions. So for those of you that know me, you've probably seen these circles a million times, but I think it brings the point across. You have to take a look at where your other assets are sitting. If they are in tax-deferred accounts, such as 401ks, IRAs, 403bs, TSPs, right? All of those are going to be taxed at ordinary income. If they're in a tax-free, and I'm just going to use Roth IRA for this example, if you have money into a Roth IRA, all of that comes out tax-free. That does not show up in your provisional income in regards to them calculating the taxation of your Social Security benefits. Now, if you have taxable investments outside in a brokerage account, such as a mutual fund or a stock or bond or cash, right? Depends on how you manage that. Now, you can also get that out tax-free. So having a tax diversified strategy is key. So going back to a lot of your questions, Joe, should I take it at 62, invest the rest, and if I die at 85, I'll probably make out? Yes, but I think you need to dive deeper in your analysis. I've done this multiple times. Is that Social Security benefit, if I wait and push my Social Security benefit out, I will receive that 8% delayed retirement credit. Until interest rates go back up to normal rates of 4 or 5%, it's going to be very difficult for me to get better than 8. But of course, this is your money. This is your retirement. If you think you can invest it and do better, then do that. However, don't ignore the taxation. Because here's what happens. Now, if I delay my retirement credit, I'm going to receive a lot higher benefit, right? From 62 to age 70, that's 73% more. Now, that's also going to be tax favored to me. I'm not going to pay the state of California on it, and at least 15% of that lot higher benefit is going to be tax free to me. If there's a way for me to get more money into a tax-free environment and start taking distributions from my Roth, that's not going to show up on my provisional income, and potentially that can get me from the 85% tax to the 50% level, or even almost tax-free. So it might make sense for me to delay my Social Security benefit, start taking distributions from my 401k or IRAs or like plans, because those are not tax favored at all. They're tax deferred, but once I pull them out, they are taxed at ordinary income rates. I start dipping into those plans to cover my income, because those are going to be taxed full boat at your federal rate, and they're going to be taxed full boat on the state rate. And then now I'm letting my Social Security benefit accrue by that 8% per year. I'm going to turn that thing on at age 70. Oh, and guess what also happens at age 70? If you have a lot of money still in your tax-deferred accounts, you have required minimum distributions. Those have to come out of your retirement accounts, and that could blow you up tax-wise as well. So just look at the taxation of this and say, hey, maybe I delay my Social Security benefits. If there's other assets that I can draw from, maybe you take a little bit from your tax deferred and convert some of that. So convert some of your tax deferred accounts into a tax-free environment to let those continue to grow tax-free for you. And then that can help supplement your income when you're in your 70s. Because I'm telling you, we're living a heck of a lot longer. Here, especially in Southern California, I see people in their 80s and they look like they're 50. So, right? So just, we can't be so short-sighted, but I get it, right? I want to get that income as soon as I can get it. Let me briefly explain some changes, and then I'll get back to some of your questions. File and suspend is dead. Sorry. Unless you've already done this strategy, file and suspend was this. This came about in 2000. It only lasted 16 years. Is that one earner could typically file for their benefit and then suspend the benefit. Because you cannot claim a spouse benefit, you cannot claim children's benefit or anything like that unless that person was collecting their Social Security benefit. File and suspend mean, hey, I filed for my benefit, but I'm just going to suspend them. I'm still going to enjoy that deferral or that 8% delayed retirement credit, and then that opened the gates for a spouse to then claim her benefits or his benefits, or children to claim their benefits if they were minor children. Restricted application is still in play, and I see this missed all the time. What a restricted application is you going to the Social Security Administration and you are not filing for your benefit. You want to file strictly for the spousal benefit. Now, this, of course, only is if you're married or were married for 10 years or 40 quarters. But here's the rub. You had to turn 62 by the end of 2015. This thing phases out by 2019. So there's still a few more years. All right. So if you turn 62 by the end of 2015 or January 1st, 1954, if your birthday was before that, you can still file a restricted application. So again, you're not filing your own benefit. You are filing a restricted application. So you're saying, no, I don't want to take my benefits. I want to take the spousal benefits because I want mine continue to accrue. You can only do the restricted application if you're at full retirement. All right, so retirees who have already filed for file and suspend and filed their claims, restricted spousal benefits, they're grandfathered in. There's not going to be any effect. Take it, right? You're fine. Retirees born before 1954 or earlier may still be able to file that restricted spousal benefits. All right, so take a look at this. This might increase the overall benefits to the household. Now, why will your benefits change potentially? Well, I don't know. There's a couple of different things. Right, earnings increases, decrease within the OASDI fund, cost of living adjustments. Are they going to change that? Payroll taxes collected. Is there what changes are going to happen here? Because a lot of you are thinking, Joe, I'm going to take this thing at 62 because Social Security is going to blow up, and I want to make sure that I can get a few bucks out of the thing before it goes broke. I get it. There's concerns, and I understand your concerns fully because I'm concerned as well. So for the last couple of decades, the OASDI cost rate is projected to rise rapidly, right? Because you have 10,000 baby boomers turning 65 every single day. There's just demographic factors. So for the next few years, we'll see a sharper increase in the cost rate as a result because of the recent recession that we had in 08 and everything else, people, high unemployment. But the OSDI fund is still there. It's not going away until 2034. 2034. So then it's broke. Then it's exhausted. There's roughly $2 trillion sitting in this fund. Okay, 2034, it goes to zero. That does not mean that you will not receive Social Security benefits. If they don't make any changes to the system, then only 80% of your scheduled annual benefits will be able to be funded if they don't make any changes. All right, so 2034, just kind of keep that in the back of your mind. Now, about a few years ago, that was 2037. Now it's 2034. You can kind of see where that is going. But by current law, if you've claimed your benefit, you are grandfathered into what you've claimed. What's going to happen? It's going to affect the people behind you. So restructuring Social Security, right? It's a huge political agenda. But here's what I think is going to happen. They'll probably delay full retirement age, right? Even further. So I'm in my 40s. My full retirement age is probably going to be 70. People in their 20s is probably going to be 72. Who knows? Reduce the cost of living increases. Well, we haven't really seen a lot of cost of living increases. So for years, people kind of assumed around a 2% increase. Last year, it was 0. This year, 2017, it was 0.3. Most people got $4 a month. I mean, what can you get? It's a cold beer. Modified the benefit formula to reduce your basic benefits. I think this also may happen. This is means testing. That's just a really polite, nice way to say means testing, I guess. So if you have large income, if you have large assets, if you have pension, right, it might make sense to take your benefit earlier than later, just because, hey, they could means test it and you could lose some of that benefit. They could increase payroll taxes. I mean, it seems like every second of every day for the last how many years is just always political. You know, you hear this, that, whatever. But this was very big on the political trail of what the future of Social Security is. And increasing payroll taxes is a very possible solution that, you know, Washington can do. Right now, you're taxed at about $120,000. All right, so it's now. With that, all right, well, maybe they go up to $200,000, or they don't have a limit on the payroll taxes. So that's why getting this thing is key. Few different gifts I want to get you. If you want a Social Security analysis from us, I feel this is kind of self-serving. We will absolutely do that for you if you want to sit down. But ours is more entail. I want to take a look at everything that's going on in regards to your taxes, in regards to your investments, in regards to your retirement goals, dreams, aspirations, and what the heck you're doing currently with your overall investments. If you don't want to get that deep, I get it. If you just want to go online and kind of toy with this on your own, we get a lot of do-it-yourselfers that kind of look at this stuff, which is great. Larry Kutlikoff, he's an interesting guy, but he really understands Social Security. He's been on our TV show. He's been on the radio show. And he's got a website. You can go to MaximizeMySocialSecurity.com. MaximizeMySocialSecurity.com. It'll cost you $40, and then you can put in your own numbers, and it will maximize those benefits. It will tell you what claiming strategy is appropriate. However, be careful with some of these calculators. You need to take a look at the tax implications of your income and how that's going to affect your provisional income. Are you married? Are you single? Do you have an ex-spouse? Do you have multiple ex-spouses? Right? What is your benefit compared to your spouse's benefit? Is there other fixed income involved? So it gets a little bit more convoluted. But either way, you can always contact us here at Pure Financial. You can email me directly at joe.anderson@purefinancial.com. I'll be more than happy to kind of answer any of your questions. We have a few minutes left, so I'm going to answer some of these questions. So one question here was, can you still do Roth conversions after you no longer are working? The answer is absolutely yes. If you retire, right, yes, there is no income or AGI limitations to Roth conversions, only Roth contributions. So those are two separate things. So if I go back here to our lovely three circles of life, any dollar that you put in as a contribution into the tax-free bucket, you are restricted by income. So if you do not have income, you cannot make a contribution, and if you make too much income, they won't allow you to make that contribution. But let's say you retire, right? So you retired this year. Your income is going to be lower. You have money in your 401k plans, IRAs, 403bs. Absolutely, there is no income limitation to do a Roth IRA conversion. So the lower the income, the better, right? Because that can maximize how much more money that you can get potentially into a Roth. You will pay tax on the conversion. So the lower the tax bracket you're in, the better off you're going to be, because the tax hit is not going to be as bad. Now that money's in a tax-free account, that will grow tax-free. You can delay your Social Security, right? And then it's just a combination of a couple of different things. So is capital gain income considered provisional income for taxing Social Security benefits? Unfortunately, yes. Anything that kind of shows up on the 1040. However, there is strategies to reduce that if you do tax loss harvesting. Right? Also, if you're in that 15% tax bracket, right now there is no capital gains rate. So it's going to depend on what tax bracket that you're in to try to avoid or eliminate or try to manage the assets maybe a little bit different to try to get a lot of those capital gains off the 1040. If you have actively managed mutual funds, those are very not tax beneficial because they kick out a lot of dividends and interest that you have no control over because the portfolio of mutual fund managers doing it. So it gets a little bit more challenging. There's other investments such as maybe exchange traded funds, institutional funds, index funds that are more tax sensitive, and maybe you keep those in there. And again, it's just kind of monitoring it and looking at some tax loss harvesting along the way. All right, is the earned income reduction for a married couple based on individual's income or combined married income? Oh, all right, so this is yeah, it's a good question. That's only on your income. All right, so again, let me go back here. So that's tax. So if you're reducing the benefit, so this is this number here, $16,920. That's only your income. So if your spouse, let's say I'm collecting my benefit at 62 or somewhere before full retirement age, it's just my income. My spouse can make $100,000 a year or more. They're not going to include that. It's just your income for the cap. So it's $16,920 just on your income. However, the taxation of Social Security, sorry I'm flipping around here so much, but these numbers, that's combined income. So that would be combined income. All right, I got time for one more. If I sell an investment home or residential home, will income proceeds from the sale affect my Social Security benefits or cost of Medicare? Let's see, it could if I sell an investment home or residential home. Now, let's start with the residential home. If you sell your residential home, if you've lived in your residential home 2 out of the last 5 years, you get what is called the 121 exclusion. So you can exclude up to $250,000 of gains if you're single, $500,000 if you're married, all right? Now, if it's, let's say, a commercial property, or maybe it's a single-family resident or condo that you're renting out, yes, this could affect, because if there's a taxation included in that, it's going to spike up your Medicare, because Medicare's means tested, so the premium that you're going to pay for Medicare potentially could go up. It depends. So it's just looking a little bit more. Of your residents, you should be fine unless you have huge gains. So $250 if you're single, $500,000 if you're married. Any dollar over that, yes, you're going to be subject to a capital gains tax. But if you do have a commercial property or an investment property, then that's going to depend on your basis, what you paid for it, what you're selling it for, what the depreciation recapture is, and everything else. Then it's just trying to find other type of solutions to try to mitigate that tax so you can avoid or mitigate it as much as you can so it doesn't blow you up. So that's it for me today. I kind of blew through this. There's a ton here. Hopefully you enjoyed it. Social Security is dry. It's complicated. There's so many different ways that you can kind of look at this. I try to give you a high level and just some tidbits here just to think about things maybe a little bit differently than you were currently thinking about claiming your benefits. Again, if you claim it at 62, you're going to receive a haircut, but if you have shorter life expectancy, it might pay off to take it, or now after going through this, it might make sense to push it off. Hopefully you enjoyed it. Always go to purefinancial.com. You can watch our TV show there. Now we're in our 4th season, if I do give myself a shameless, awful plug. And then, of course, our podcast. You can get a lot more information on our podcast, YouTube channel, all the good stuff. Hopefully you enjoyed it. Stick around. Next month, we'll have another part of the webinar series. So hopefully you enjoyed it. Please send me your questions, feedback. Hopefully, again, you got a little bit out of this. Appreciate your time. Have a wonderful day, everyone.